Okay, thanks, Kerry, for that. And yeah, welcome everyone. It's I always think it's nice to be able to hear at the beginning of every season, you know, what everyone's thinking about, what the weather's doing, what the economy's doing, and really to get a sense of how we can start to plan. You know, I think really it's very hard for everybody or even the experts to suggest where markets will go, what interest rates will do, or what the weather will do. So I guess where we come into it is if you can't predict it, then try and hedge it. Try and hedge your risk somewhere. Particularly when we're talking, you know, obviously a lot of producers, there's a lot of risk on the table. You know, when you look at a farm balance sheet, you can see that, you know, that there is debt on the table and interest rates are going to affect that. When you look at it in terms of the weather, you're about to put a new crop in and you're worried about what's going to happen in terms of the weather. So let's see that. So I guess our view, or yeah, got it. Okay. Thanks to the Future Drought Fund, we've been doing a lot of research into insurance, a lot of innovations occurring, a lot of testing, so we can make sure that the balance sheet or the movements on the balance sheet can be, I guess, less volatile. In farming, we tend to look at ourselves at about a 7-year cycle where there's some good years and some bad years. What we looked at is innovation using a type of insurance, parametric insurance, which we'll go through. But essentially, the whole idea is to smooth your balance sheet. You know, make sure that sort of Andrew's comfortable with your loan book. Make sure that you're comfortable with your income. Make sure you're not going to get that volatility. So we feel insurance certainly has a play. There was a National Farmers Federation survey done in 2019, and it basically said to us that you know, production risk was one of the most important things. 56%, 80% of farmers rank drought as the single risk to sustainability. If we can control what or how we can manage, whether it's on farm, whether it's adaptation, or whether it's an insurance product like a parametric product, if we can control what we actually think about how we can control drought, then that eases a lot of pressure on our balance sheet. 71% of farmers take on more debt in bad years as well, you know, hoping that in the good years, it'll be all right. But then again, when you really think about it, particularly up around Stanthorpe in this area, we had drought for 7 years. You know, so you think about it, it's all about trying to manage these expectations. And that feeds just not from what producers on the farm, it feeds right through to the community as well. So if we've got a means to be able to spread the word in how we are going to manage this risk, then the better off is for the community as a whole. And then 68% of farmers said they're prepared to give up something to get $250 a hectare back. It's quite interesting when you look at it, because when you look at the risk that the grower has, we often say, particularly in broadacre, they're spending $300 to make $900. How do we get those inputs back? You know, when these events occur, are we safeguarding the ability for us to be able to get some income to start things off again? Parametric products are one means. And we've got farm adaptation methods, could be more dams, all these sorts of things all make effort. They all make something that we can use. So it's having that in your quiver, these little products to pull out when you need them. So what have we been doing about it? Okay. FDF, Future Drought Fund has allowed us work an appropriate insurance product to insure against yield loss. This is sort of a pet project which I like, because we're actually wrapping insurance around how the plant behaves to weather events. And to me, it's sort of doing that sort of study, and I've got a couple of examples about making structures appropriate to the risk. And as we look at it in some cases, and one of the classics I like is that with canola, we lose 3% for every degree over 28%, 3% of yield when we get a heat day, anything over 28 degrees. So if you get a prolonged heat wave coming through, then you're certainly losing a lot of yield, and that's a lot of income. So we wrap these insurance products, we understand how the plant behaves, and then we put a product around it. We build an understanding of the willingness to buy. And I guess through the Future Drought Fund, we're having conversations with growers, we're having conversations with reinsurers. So we're on both sides of the fence, trying to understand what someone will charge for risk and what someone is happy to pay for the risk. And to me, that's one of the most important things, because that creates that market, and it always creates that involvement in the market that enables these products to continue. We feel that parametric insurance offers that previous scope to hedge production risk, seasonal risk, specific event-driven risk, and a likely quality downgrade. All these little areas sort of can be catastrophic risk, or they can just sort of like stop you maximising your return. A classic of that is a wet harvest. You know, when we look at a broad acre, if we're looking at wheat, for instance, you know, if we get a bit of rain around a 3-week period, that could be anywhere between 30 and 50% downgrade. So that then sort of you have to refocus and say, well, that 3-week window actually cost me a lot of money that I could have hedged. And that also increases my ability for sustainability in what we do. So what is a parametric insurance? And I think this is the beauty of it. It's basically a cover. It's a non-indemnity cover. There are 2 types of insurances. One is indemnity, one is non-indemnity. Indemnity means you have to have proof of loss to show. Non-indemnity means that if the triggers occur, you get paid. Some of our farmers say that's gambling, but I always say when you put a seed in the ground, you gamble. You know, we're trying to understand what the weather actually does and how that will affect. So we design products around it. With a parametric product, there's no proof of losses required. No excess needs to be paid, and payouts are automatic once the policy is triggered. This creates efficiency. And the important thing about it is when you have that extreme weather event, you get paid if the policy triggers are based on a weather station, you get paid within 5 days. What does that mean? It means you've got money that comes back straight in. Money come back in to rebuild what you've lost, to maybe build a new dam, create new inputs. So in terms of that, it's the importance. The important thing is being able to get money to the spot where it's needed the most. And this is where a parametric insurance product helps. The good thing is we can tailor it to any crop. We did a lot of work, and Brooke would know, we did a lot of work up in the pineapple land. And we started to understand, talking to the growers, what happens to pineapples? You know, what actually happens to pineapples? You know, is it hail? Is it cyclone? So we started to get a sense of how the plant behaved to the various weather events. And I often find that, and I didn't realise this, but one of the big events is sunburn. When the pineapples get sunburned, they have to put sun cream on them, and that sun cream stops yield loss. So then we decided to wrap a product around it. And we said, okay, well, if it's going to be a hot day, anything over 35 degrees, we've got to have some form of payment. So then we started to talk through industry on that. So it was that interaction with industry that helps us design a product that makes sense to that community. And to me, that was one of the most important things, is that interaction where we can have that conversation. And events like this, in my mind, enable us to have that conversation so that it makes sense. So the covers make sense. I think one of the interesting things, and it always sort of gets under my skin a little bit, we'll always take insurance against, you know, a depreciable asset like a farm machine. But we never take insurance against on a crop, whether it's there or whether it's not. But that's your asset. That's your ability to take that asset. What you've got in the ground is your asset. If you're on broad acre, you've got 2 to 3 weeks of risk that people don't insure against it. Or there's not a market for it, or it's too expensive. So we have to explore the reasons why and then come up with something, a product that makes sense. And I think when you look at it, some of the products, dry, and what Alister said, he said, okay, it's going to be dry. So what does that mean? You know, is it going to be rain at the wrong time or no rain? Are we going to get another 2-3 years? As experts, we can only guess what's going to happen. We can only get an idea, you know, through the tools that we have today. But everything's changing. You know, we're getting a 1 in 100 year event every couple of months. So the chances are that we've got to be prepared. We've got to start to understand what makes sense in terms of us to try and hedge our book. So what I like is that through a parametric product, we can build things. We can understand drought, extreme heat, extreme frost, excess rain or flood, hail and cyclones. And some of the most exciting developments are starting to occur in the hail and the flood area. When we look at some of the pricings for flood, there are no products, but parametric offerings are now providing those products. And we've got these little tools that are helping us to make these products actually work. So when we look at a parametric product, when we look at a policy, it's all designed around the data that we can find. What is the data that makes it? Because through the data, we can then see areas of risk. We can say, well, to a farmer, do you remember, in 2018, where we had a couple of days of excess of 50 mils of rain, or we had a season, we had a decile 1, decile 2 event. So it's that data which is important, because that data helps us to define the thresholds and the triggers for a parametric product. Parametric, you got it, parameters. So we're just dealing with parameters here. So we design it. So whether it's the bomb weather station, bomb grid data, the cyclone data, hail sensor plates, and that hail sensor plates, to me, you can't get hail cover in a lot of areas, but you can with a sensor plate. It sits in the paddock and it measures, falls out of the sky. What the NRMA ad says, when the clouds stop throwing stones at you. These sorts of sensors just sit there. And then when there's an event, we can measure the size and the velocity of it. So we then tailor the products around it, tailor the parametrics to say, well, if I'm going to get 10 centimetre hail, then I need to pay out because it's just decimated my crop. These can all be done. And to an extent, they're quite accurate. With the QFF and the Future Drought Fund, we've been doing hail sensor trials for the last 2 years. And it's great. All the farmers get on. When there is an event, we all get on and we all talk about it. And we all say, well, here's the information. We share the information so that people can understand that when there is a hail event, what does it look like? What does the reporting structure look like? All these things to try and design the right product for the right industry. And so far, we're quite happy with that, where we can see all the events that occur. We're also interacting with the BOM, saying to the BOM, okay, well, if this event occurs, we had an event just a couple of days ago. And we said to the BOM, what did you see? This is what we see. So we're reconciling that data to make sure we know that the hail sensor plates actually work. To me now, the next section is flood sensors. When we talk about flood, it's very hard to get indemnity-based covers. Through Insurtech, through technology, we're now delivering. We're using satellites. We're using sensors. We can sense. One of the particular ones, we have what we call flood base and flood flash. These are two international products that are starting to get the rounds. One, you've got similar to a sensor plate, you've got a flood plate. Strap it to the side of the building. Flood starts to come up, see the water, trigger something to the satellite hits it, comes back, and the server picks it up. We know how much rain, or we know how much the flood has occurred, and then the payouts occur. The other one is remotely sensed through satellites. We can see when the floods occur. So if it's remotely sensed, we can then start to build a product around it. So it's a really exciting area, and it's all about being part of this conversation. With Andrew, at the NAB, he's got a loan book out there. He's saying, well, okay, is there a chance that if I use a parametric product to control that, could I reduce the cost of that money? Because you've effectively got a stop loss. To say, well, if I get a decile 2 event, I know I'm going to have a problem, but hey, if it gets to decile 1, at least I've got income coming through. And to me, that is the important thing. So I guess during here, it's sort of the test of any product is in its ability for people and farmers to understand and be comfortable with it. And these are the conversations. And this is one particular farmer in Moree. He's been using, we call them weather certificates, which is a parametric product. 2019, using the weather certificate was absolutely invaluable. 100% of crop failure with a 7-figure loss turned into a minor loss. Weather forecasts were not promising, and we used weather certificates to balance financial risk, production risk, to mitigate the worst case scenario. The bank liked the idea of a weather certificate and helped with refinancing. We use weather certificates for insufficient rain to grow a crop and hedge against yield loss and quality downgrades to chickpeas. Partial payout of the contract covered the losses. This is someone that gets an idea of it. That understands the value of these types of products because he's saving everything in terms of sort of getting that cash flow into his balance sheet. It's very hard to say at the beginning of the season, I'm going to allocate $500,000 to something. What mechanism do I have to get that back if things go bad? What do I have to recoup that to get my cash flow happening again? And to me, that's one of the most critical things. It's sort of, you know, how do I, or what can I use? And I think the tools are there to be used, to be investigated. We've been doing it since 2012. And on that journey, you learn a lot about what are the pitfalls, what are the good things, what are the bad things. And the project with the Future Drought Fund has allowed us to actually do a big deep dive, get the right products, get things moving. So there's another graph, WA. I would be able to offset some of my production costs, which have risen considerably. Now, that's a big fight for a lot of people. Just saying, well, how can I manage that? The cover I took out meant that the downside to our financial position is not as poor as it could be. I can rest easier that financially I can protect the downside, and more importantly, the effect of drought has on us personally. And to me, that's another thing. When you are at the farm table, you know, you are talking about a business, and you're talking about how the business can be sustainable. And I think, to me, that's the important thing. Trying to marry up a particular cover that makes sense and that's affordable. And that's the most important thing. So, building farm resilience. Without a weather certificate or a parametric product, we can see the bad season. With a weather certificate or parametric insurance product, you can see the benefits. It enables you to recoup some of the losses that you have. It enables you to be able to start again afresh. When we look at these products, it is about that interaction with the grower. It is about that discussion at the farm table, trying to understand exactly what's happening. And to me, that's the most important thing. Having that discussion and saying, these are my risks. You know, planning for the season. You know, have we got a low soil moisture profile? You know, have we going to have problems with irrigation in terms of the cost of water? You know, is it going to be hotter? All these questions, when you do your planning, your budget, your farm budget for the season, you look at the risks and you say, well, what am I worried about this year? Alister will come out and say, this is the problem. You know, Andrew will come out and say, this is what's happening to interest rates. Okay, they're my risks. I'm identifying the risks that I have. And if I identify that risk, then I can say, well, how can I mitigate them, or what makes sense to mitigate? When we look at this, when we build a parametric index, we look at the season. We look at the emergence rainfall, the establishment rainfall, frost, heat, excess rain, wind throughout a whole season. And then we can start to sort of get an idea of where's my concern. We can, and we always look at, we can say, well, during the season, you can sort of have a look and say, gee, it's going to be a tight finish this year. These types of products can be purchased 30 days out from the event. So you can sort of have a look at it, be prepared. Prepared to say, well, this is a problem that I might have, and this is something that I think I can use. And then we try and price it up. To me, when I look at it, reduced yield from heat stress for canola is a big one. Canola is a huge market at the moment. It's growing, growing, growing. Downgrades from excess rain are also a huge one, because within a 3-week period on your harvest, you're susceptible to a 30 to 50% downgrade. So that brings a season, which could be a good season, into a scratch season. So these sort of products, particularly on the downgrades, are good. We understand in some products what the excess rain does. And as a producer, you understand how rain will affect your crop. So we design it. Design a cover built around an index that we pay for. In order to do this, the Future Drought Fund has enabled us to do a big dive. When we look at insurance, we like to say, does it make sense? Is this an insurance product that creates that return for me? Does it make sense? Because remember, insurance is all about not one payout. It's all about sort of managing your cash flow over time. The bad year, you'll get paid. The good year, you'll be paying premium. Premium, bad year, get paid. Premium, premium, bad year. So it's all about managing that. And of course, yes, there is a cost involved in that, but it is all about managing your cash flow over time. We do an economic assessment, premium versus payout. A lot of growers say to me, look, if I pay this amount over this time, will I get this amount back? And we do that analysis to say, well, does it make sense to do it? In my mind, that's not a true reflection of what it's meant to do, because we're reducing the volatility. But still, we put that in there because growers like to see it, and then we take it. We look at the volatility of income, the average income in the worst years versus with and without, and the difference in the square root. So these tests are standardised tests we look at on insurance products to make sure They make sense. And here's one economic assessment. You can see here in some areas, there's a small loss. Some areas have a gain. But that's all about the weather, because the weather is volatile in other places. So when we look at those sorts of types of returns, we can say, well, okay, well, that makes sense. This was actually for frost. Some areas it made sense, in other areas it didn't. Premium versus payouts. In some areas it did, and in some areas it didn't. But mind you, this is over a 40-year period. So when you actually look at it and divide those numbers by 40, it's not that much of a difference every year. So in terms of that, it's got to make sense. A low number here enables us to say it lowers your income volatility, which is what we like. And then we test for appropriateness, because a lot of people come to us with questions about, okay, let's look at the data. How can you trust the data? Is it the right data? That's what I say. Is this the data that I can use? Well, all these products are used, all this product data are by independent providers like the bond, and then we look at it. But the most important thing for us is to suggest, well, is the growers data similar to the bond data? You know, and is there a basis risk that we have to match? And we do that, because a grower might have one station, weather station, 2, 3, 4 stations. We can easily grab access to his data. We grab the bond data, we look for a correlation. If the correlation is high, it makes sense. If it doesn't make sense, then it's not worth putting it together. So we like to always think that when you look at data, make sure there's a high correlation to the product that you're using. So these are the sort of things we've looked at. Step-by-step tutorial on structuring an appropriate hedge, which we like farmers to look at. Understand the key, and one of our particular clients that have been using this, he said the most important thing is to be sure the key terms and what they mean. I've had instances where growers will ring me up the day before we have to start. And they say, oh, I've got to have it, I've got to have it. I said, have you read things? Do you understand things? No, I've just got to have it. They haven't done their homework. They've got to understand it. And even if at the beginning of the season, you sit down with somebody and say, I don't get it, I don't get it, I don't get it. Slowly it happens. Slowly you start to understand it. Define the risk and the risk period. The most important. You know, we've had growers that said, well, okay, at harvest, you know, I bought the product thinking. I said, well, did you understand that was your harvest period? Oh, no. I said, well, that's why you're covering it, because it's your harvest. And give yourself a few days. If your harvest is going to last 2 weeks, make sure it's done over 3 weeks or 4 weeks, just so you can be sure. Locating in the correct location. We've had several farmers, they haven't even got the location right. So they've basically looked at it and said, oh, I like it, I'll buy it, but they've got the wrong location. Historical data. We take 100 years worth of data to try and make sure that we know that this policy works. A policy in these sorts of instances, people will say it's more expensive than a traditional farm like fire and hail, which comes in at about 3.5%, 4%. Think of it with a parametric product. You look at it, if it's paid once in every 10 years, it's got to be 10%, because that's how you do it. So you are paying for something that's appropriate. And to me, that's the most important thing. We could price a contract which is about 3% or 2%, but the return period might be 1 in 100 years. And that's fine. But is it appropriate for the risk that you're actually looking at? And we go through those. We define the parameters, because the parametric product is all about the parameters. Tailing the parameters. You purchase a hedge, and you just track the progress. And through InsurTech, this can all be done online now, so you can check it. So by combining certain perils, we have growers that will look at things like a wet harvest, cumulative rain days. We know for cotton, for instance, which is now coming up. We know if you can't get in the paddock, you've got some issues. We know that if the cotton gets wet or it sits in the bowl, there are some issues. We know that if you are sort of fortunate enough to have a summer and winter crop, then if you can't pick, it's going to delay your winter crop. So it's all these sorts of things that you look at. We can look at germinating. It's incredible the amount of different things that you can look at that sort of make the more of the risk that you have.